The passive income lie banks don't want you to know. Your bank is stealing $127,000 from your retirement, and they've convinced you it's impossible to stop them. In the next 8 minutes, I'm showing you the passive income streams Wall Street has hidden from Americans for decades. Stay tuned. Look, I used to believe what every financial advisor told me. Work hard, save money, and eventually you'll be able to retire. Simple, right? Wrong. And here's the thing that really got me. The people telling me this were making millions while I was grinding away, barely keeping up with inflation. That's when I realized something wasn't adding up. The banking industry pulls in over $200 billion in annual profits. The stock market manages roughly $100 trillion in assets, yet the average American has less than $6,000 in savings. You know what that tells me? The system isn't designed for you to win. It's designed for them to win while you're distracted thinking you can't. But here's what shocked me even more. There are actual, legitimate ways to build passive income that most people have absolutely no idea about. Not some sketchy cryptocurrency scheme or get-rich-quick garbage. I'm talking about real, boring, unsexy money-making strategies that rich people have been quietly using for generations. The reason you haven't heard about them? Because banks make money when you keep your cash in checking accounts earning basically nothing. They make money when you take out mortgages. They make money when you pay interest on credit cards. They do not make money when you're building wealth independently, so they keep these strategies quiet. Let me break down what's actually happening to your money right now. The average American keeps about $4,000 in a savings account. That account's earning you maybe 0.01% interest annually, if you're lucky. Some of you might have gotten a high-yield savings account earning 4 or 5%. That sounds amazing until you realize inflation is eating away at your purchasing power faster than that interest is growing your money. You're literally losing money by sitting still. But it gets worse. According to Vanguard data, the average American retirement account has grown at just 6.5% annually over the last 2 decades. Meanwhile, people who have figured out alternative passive income strategies, they're seeing 8, 10, sometimes 15% annual returns. Over 30 years, that difference compounds into hundreds of thousands of dollars. That $127,000 figure. That's a conservative estimate of what the average person loses by not knowing about these strategies. Here's the first passive income stream most people completely ignore: dividend-paying stocks and index funds. I know, stocks sound complicated, but stay with me because this is literally how rich people get richer while sleeping. When you buy a share of a company, you own a tiny piece of that company. Many companies, especially large, stable ones, share their profits with shareholders. That's called a dividend. You're getting paid just for owning the stock. Here's a real example. Let's say you invest $10,000 in a stock index fund that focuses on dividend-paying companies. That fund might pay you a 3% dividend annually. That's $300 a year. Sounds small, right? But here's where most people mess up their math. If you reinvest those dividends, meaning you buy more shares with that $300, now next year you're earning dividends on $10,300. Then on $10,609. It compounds. After 20 years, that $10,000 could turn into nearly $24,000 without you doing anything except not touching it. And that's not even counting stock price growth. The banks absolutely know this. They're doing it with their own capital right now. But they need your money in checking accounts and savings accounts where you're not building generational wealth, because that's how they profit. Second passive income stream: rental properties and real estate investing. Now, before you tell me you can't afford a rental property, hear me out. You don't need to be a landlord collecting rent checks to profit from real estate. There's something called real estate investment trusts, REITs. Think of it this way. A REIT is a company that owns and manages real estate. When you buy shares in a REIT, you're essentially getting paid for your tiny slice of those properties. Someone I know invested $5,000 in a REIT focused on commercial properties back in 2015. She's been receiving dividend payments ever since. Over that time, she's collected roughly $8,000 in dividends, while her initial investment grew to about $12,000. That's passive income from real estate without any of the headaches of being a landlord dealing with tenant problems and maintenance calls at midnight. The housing market is controlled by big investment firms that buy up properties specifically to generate passive income. They understand that real estate is one of the most stable, tax-advantaged ways to build wealth. Meanwhile, regular Americans are just trying to save enough for a down payment on a primary residence, not realizing they could be building a real estate portfolio in their spare time through REITs. Third strategy: high-yield savings bonds and Treasury securities. The government literally sells IOUs. You lend them money, they pay you interest. I know that sounds boring. It is boring, but boring is making millionaires right now. Treasury bonds are currently paying around 4 to 5% interest depending on how long you lock up your money. That's significantly better than most banks without any real risk because the US government backs them. If you invested $50,000 in Treasury bonds at 5%, you're making $2,500 a year in interest. That's completely passive. No stock picking required. No property management. Just money sitting in a government-backed security earning you cash. If you did that at age 35 and let it sit until retirement at 67, you'd have over $270,000 sitting in bonds alone, and that's not counting the compounding growth. But here's what drives me crazy. Most people think government bonds are something only wealthy people invest in. They're not. You can buy them directly with as little as $100 through Treasury Direct. There's literally nothing stopping you except the fact that no one ever told you about it. Fourth, and this is the one that literally changed my perspective: dividend reinvestment and automation. This is the hidden weapon wealthy people use. They don't check their investments obsessively. They don't try to time the market. They set up automatic dividend reinvestment and then they ignore it. This is called DRIP, Dividend Reinvestment Plan. Here's how it works. Every time your dividend is paid, instead of taking it as cash, you automatically buy more shares with it. Those new shares generate dividends. Those dividends buy more shares. It snowballs. Someone who invested $20,000 into a dividend-focused portfolio 30 years ago with DRIP enabled would have over $500,000 today, probably more depending on which investments they chose. And they literally did nothing after the initial setup, except maybe add money annually. This is what the banking industry doesn't advertise, because it puts you in control of your wealth instead of them. The solution is actually straightforward, and honestly, kind of anticlimactic compared to how dramatic this problem is. Step 1. Stop keeping your money in traditional savings accounts. This is non-negotiable. Open a high-yield savings account. You can do this in literally 15 minutes online. Ally, Marcus, Capital One 360 are all options. That's $6,000 the average American has sitting in regular savings. At high-yield rates, it generates maybe $240 a year instead of basically nothing. Step 2. Open a brokerage account. Vanguard, Fidelity, or Charles Schwab. These are safe, regulated, and you're not trusting some random app with your money. You're trusting massive institutions. From here, you can invest in dividend ETFs or index funds. An ETF is basically a basket of stocks grouped together, super diversified, super boring, super effective. Step 3. Automate everything. Set up automatic monthly investments. Set up dividend reinvestment. Automate transfers from checking to savings. Then forget about it. Don't check every day. Don't try to be a day trader. The people making money in this space are the boring ones. Step 4. Actually educate yourself on tax-advantaged accounts. Your 401k, Roth IRA, and HSA are basically the government saying, build wealth this way and we'll give you a tax break. A Roth IRA lets you contribute $7,000 a year, and every dollar of growth is tax-free forever. Not tax-deferred. Tax-free. This is insane, and almost nobody maxes these out. The reason Wall Street doesn't shout these strategies from the rooftops is because they want you dependent on actively managed funds where you pay them 1% annually in fees. They want you confused so you keep your money in low-yield accounts. They want you to think passive income is impossible so you keep working that job, paying taxes, and never building generational wealth. But now you know, the passive income isn't hidden. It's hidden in plain sight. It's boring. It's not exciting. It's not going to make you rich next month. But over 5, 10, 20 years, this is how generational wealth gets built. This is how people retire early. This is how your money starts making money while you sleep. The choice is yours. Keep trusting a system that's designed to benefit the banks, or take 30 minutes this week to set up systems that benefit you. Your future self will thank you for it.